everybody. Welcome to TraderMerlin Show for your Tuesday afternoon edition. As you guys undoubtedly know, we had some interesting things happen in the bond market last week when we had a quote-unquote inversion of the yield curve. Of course, we talked a little bit about that on the program, but then all of a sudden there were more things that started to go in an inversion type of state, and that leads me to wonder, well, what the heck does it all mean? Should we all run to the hills in panic and sell all of our assets and scream and run to the ocean because the world's coming to an end? Probably not. As I mentioned the other day, there's this huge lag time between when you have an inversion and when a recession ultimately comes. But let's dive a little bit deeper into that topic. I had to have some fun with this graphic today, which is, when is an inversion not an inversion? As you can see, I've got Bill Addiss hanging from the ceiling up there with some upside down numbers. Bill, welcome back to the show. Sorry we don't have your video today, but glad to have you with us. How you been?
Thank you. I've been very well. I'm sorry I'm missing that video you provided there. Things are going very well, thank you. But it's certainly been an interesting time in the bond market, that's for sure.
Yeah, let's walk through a little bit. So there's obviously a lot of different things we could look at. There is the traditional, I guess the benchmark for a quote-unquote inverted yield curve is the 10 and the 2. Am I correct there?
No, actually it's not.
Dang
Sorry, you're so close though. You're only off by a year. No, it has not been. You go back to any of the conversations even you and I had, right? Even going back to before the pandemic, when the yield curve was inverted and we were talking about it, the traditional economics 101 definition of an inverted yield curve is comparing the yield of the 1-year treasury, T-bill, compared with the 10-year treasury note. Because, as you know, the yield curve is a whole bunch of data points along 30 years of maturities.
Right.
And at any given point, you could have one higher than the other. I mean, for the last month, the yield on the 20-year treasury has been higher than the yield on the 10-year treasury. Well, that's technically an inversion. But honestly, when you're comparing the 20 to the 30, nobody really cares. So
Right.
Even though it's been inverted, the answer is so what? So when we talk, we go back to the yield curves you and I have been looking at. When we measure the inversion, traditionally we do it to the 1-year treasury versus the 10-year. Now, the Fed also about 5 years ago started also using the 3-month. They even come in a little bit shorter. So sometimes you'll see it compared. So here's what happened. Last week, parts of the treasury yield curve did invert. And I'm not saying that isn't significant, but the yield on the 10-year treasury got lower on last Monday, a week ago from Monday, than the 7-year. So we had a slight inversion, 10 to 7. And then the yield went inverted to the 5-year and then the 3-year. So as the week went on, the yield curve was in fact starting to invert, but it wasn't a classic, here's the inversion we all have to worry about. Because I was home last Tuesday. I wasn't doing any training, and I have MSNBC or Bloomberg on the news in the background all the time. And all day, every talking head on Bloomberg was talking about the yield curve inverted.
Right.
And it's like, no, guys, it hasn't. It is inverting. Don't get me wrong. And whether it will or not is still up for the debate. But the yield curve has shown signs of inversion.
Right.
But it is not an inverted yield curve that you and I have warned people to worry about. It's like the press picked up this word inverted yield curve and they're now just beating it to death.
Well, I think that they've grabbed on to one definition of it. And again, if you say the yield curve is inverted, then I guess technically we should be looking at the 1 month versus the 30 because that is the full yield curve, right?
Exactly, right.
But I think the industry has latched on to a definition, kind of like we look at unemployment as the U3 rate. Well, I think most people realize it's probably the U6 rate, right?
Right.
I think
exactly.
with the yield curve, you watch CNBC, Fox, Bloomberg, they're all going to say it's the 2-year versus the 10-year. And I run with that one as well. And I want to show people something here just to piggyback of what Bill was talking about. What I'm looking at right here is the 10-year versus the 2-year. So anytime it's below this green line on the screen here, that is a quote-unquote inversion of those two bonds, the 10 and the 2. And as you can see, we have over the past few days definitely inverted because it went down below. However, if we go back to this little blip we had below it back in 2019, we did also just a slight little blip below it. So now media outlets, and including myself, are saying, hey, we have an inverted yield curve. But when I look at the 10 versus the 1, which is what Bill was just talking about, notice the difference between the 10 and the 1. Right now, you're getting about 0.8% more by being in the 10-year versus being in the 1-year. And that would theoretically be a normal yield curve. But I wanted to show you back here in 2019 when we had the inverted yield curve the last time. And everyone's like, oh my goodness, this is leading to a big recession. And lo and behold, you can see that we did have the 10 and the 1 inverted in 2019. We have not seen that yet. Now, to add to this, a lot of people made a big deal about the 30-year. And here's the 30-year versus the 2. Now, what I think is definitely noteworthy here is the colossal sell-off in the distance between the 30 and the 2-year going back to January of 2021. The difference between the 30-year and the 2-year bond was roughly 2.4% difference, meaning you would get 2.4% more for holding the 30-year. Now, as of right now, you'd be making just a teensy, like almost an insignificant amount more for holding 30-year bonds versus 2 years. So I wanted to just show those 3 charts to everybody to kind of paint that picture. And by the way, back in 2019, we did not have an inverted yield curve with regards to the 30-year and the 2-year.
Right.
So Bill, does that make a difference? Like, I'm looking at this 30-year right now, and when we had that recession back in 2019, there was inversion on the 10 and the 1, and on the 30 versus the 2, it wasn't even close back in 2019, and now we're seeing some of the lowest levels in 7, 8. I'll look even longer here, but it's been a tremendously long time since we've had inversion in this one, technically going all the way back into 2006.
And that's because, great question, by the way, and you really are astute in this. And this is the dynamics, and I wouldn't say we're in unprecedented times, but we're really close. Because what we're seeing here is that stagflation discussion that we've been having. So if you wouldn't mind, I'm sorry I can't see, the slide that I provided you with today's yield curve with all the blue arrows on it.
Yep, got it.
If you could throw up that slide. So let's take a look at what today's yield curve is, exactly as you just said. Where now you can, and this was taken as of this morning, but the blue line represents the yield curve right now as we sit here today. And the dark gray line shows us the yield curve a year ago today. And as you can see, the biggest yield curve differential has been in those short-term rates, like the 1 year, the 2 year, the 3 year, right? Yep. Look at how that gap has widened over the year, as opposed to what's happened in the long end of the market where the changes have been relatively minor. We always talk about the yield curve is dynamic, constantly shifting and shaping. So you're seeing this belly, this bulge developing in yields at 2 to 3 years. Now, why? Because we know the Fed is going to start raising short-term interest rates, right? They've told us that. Right. The question is how much and how many, but the market is expecting at least 6 to 8 rate hikes.
Yeah.
So the Fed right now is literally holding that end of the yield curve at 0.25. They've told us they're going to raise that up to 2%. We're drawing that horizontal line. That's what again, with unprecedented transparency, they've told us this is what we're going to do. So now let's say, okay, so they told us that's what's going to happen at the short end. So if we want to have a discussion as to whether the curve is going to go more inverted or less inverted, then we have to figure out what's going to happen to the longer term interest rates, right? Because the Fed doesn't control those. And that's where we get into market expectation. And that's what the long yield curve is doing in the long end. Because we've got a fight going on here between two forces going on. And I literally want you to think of this as a battle in the market. On the one hand, the Fed has told us we're going to start tapering, right? We're going to start destroying money. At the next FOMC meeting, the Fed is going to start undoing everything they did under quantitative easing. Now, again, the question is how much, how big, how fast, but we know they're going to start doing it. Now, that fact in and of itself is going to result in upward pressure to interest rates. Right. The Fed's pulling cash out of the economy. They're undoing the tapering. They're undoing quantitative easing. That fact in and of itself should cause upward pressure to long-term rates, meaning we're not going to get an inversion, right? Yes, short-term rates are going to come up, but perhaps long-term rates are going to go up also because of what the Fed is doing. The problem is, I'm sorry, go ahead. I tend to...
No, it's great. I would just want to add in, because you mentioned that the pulling of money out of the economy was helping that curve kind of move back to normal. But isn't it also that, the Fed is unwinding this balance sheet? So yes, they're going to sell these bonds, take that cash and put it back to where they created it from. But more importantly, you have them going to be flooding the market with these bonds. And therefore, when you have that much more supply, you're going to have to offer a more attractive rate to get people to buy this stuff, which most likely nobody wants.
Right. When your biggest buyer becomes your biggest seller, which is what the Fed has been and now could be, what happens to prices? Prices go down.
Prices go down.
And when prices go down, yields are going up. So the tapering should result in an upward pressure to long-term interest rates. Unfortunately, though, we've got another dynamic going on that we might be going into a recession, right? The factors that the Fed is doing, this raising of short-term interest rates, could in fact push us into a recession. And with a recession comes deflation. And that would cause long-term interest rates to go down. And there's your inverted yield curve.
Yeah.
So we really have a question here. The bond market right now is telling us we're not seeing that risk, but we're starting to see it more and more, right? As that spread narrows, that's the bond market showing a lack of confidence in the Fed, basically, saying that the Fed might not get us the soft landing we're looking for. The Fed might put us into a recession. Oh no, here comes deflation. Long-term rates are going to go down.
Yeah, I'm shocked. I'm actually putting in a poll right here, real quick. Let me just see this real quick. I want to see. Ask your community. Here's the question: how many rate hikes in 2022? Now, we've talked about this before, but I'm kind of curious what you guys think. Remember, we brought this one up, I think last time Bill was on, which is about a month ago, and not a meeting, they basically telegraphed, and remember, September of last year, it was 2 rate increases for 2022. Then we jumped into 2022, and all of a sudden it's like, hey, we maybe a little bit more than maybe 4. But in January, the Fed funds futures had already priced in 7 to 8. So I'm going to leave it up there. Everybody that's watching, enter that poll. I want to see what you guys think of this one to see how many participants we can get. If you don't know, then just guess. Remember, we have had no rate increases in 2021, no rate increases in 2020. Matter of fact, massive rate cuts in 2020 to help with COVID, which glued us to the floor again. Now all of a sudden, there's liftoff, but I don't know if anybody has ever flown out of Orange County Airport here in Southern California. If you do, there's this thing called the Noise Abatement Act, which all the snobby little rich people in Newport Beach basically filed a complaint that jets taking off from the John Wayne Airport, they're going over residential neighborhoods and it's too noisy. It's like, hey, listen, jackass, you bought a house in a flight path for an airport. That's on you. Anyway, noise abatement, because they won this, I guess, lawsuit or some regulation. When you take off out of the John Wayne Airport, it's not like taking off from a normal airport. It is like you're going straight up. It feels like you're being thrown back into your seat, going on, Space Force 1 to the moon. That's kind of what's happening here. So let me see, Bill. I'm going to see real quick what my viewers have said here. I'm going to end the poll.
Curious.
So Jimmy says 3 rate increases. 46% of the people said 8 rate increases. 42% of the people said 6 rate increases. 3% said 10 rate increases, and 7% of you said 12 rate increases this year. Now, just the fact that we would even imply there's going to be 12 rate increases this year, and mind you, there's not even 12 meetings, which means that at some of those meetings, we will have to have a 50 basis point increase. You're basically saying, oh shit, we're headed for some rocky roads if you think 12. What do you think, Bill? How many is it?
I think exactly as you clarified. I think the number of rate increases is going to be 6. That'll be 1 at each meeting for the rest of the year. But I think 2 of those will be rate hikes of 50 basis points. The Fed doesn't have to do it in quarter point hikes. They've often done greater than quarter point. That's just what you and I've gotten used to for the last decade. Right. So I think 2 of those meetings will be 50 basis points, the next one included. So that'll put the short-term Fed funds rate up at 2%.
Yep. So I'm going to
look into the 2% short-term interest rate.
I will share the graphic from the CME, and Big Eb, you're right. You actually caught me with an error there. At each Fed meeting they will increase rates, and I guess my question should have been, how many 25 basis point increases are we going to see this year? What I want to show you is, if you look at what a month ago, there was a 34% chance that we were going to see 7 to 8 rate increases for 2022. 7 to 8. And notice we've shifted significantly. There's even higher probability. Right now, it's 37% that we are going to see 12 rate increases. They're right now forecasting 2.75 to 3% for the Fed funds rate by the December meeting. That is a significant liftoff, much akin to the John Wayne Airport here. That to me seems lofty.
And I have to say, as much as I like polls, I think the more significant is the fact that the Fed themselves has told us that they see at least 6 rate hikes. This is transparency. And 2 of the Fed voting members have already acknowledged they think we have to do more than 25 basis points. So, the Fed themselves are telling us that these rates are going higher. So it's really not a question of ifs, ands, or buts. We're just massaging the fine details here. 6, 8, 10, they're going up for the first time in 4 years.
Right. Well, and I guess, if I was running this show here, the Fed, not this show, but the Fed, I would be inclined to start with 25 basis points. And then the next meeting, I'm going to do 25 again. And I'm probably not going to jump to 50s unless the doo-doo really hits the fan, because to me, when you start to make those aggressive changes to the Fed funds rate, the trickle-down effect of the economy is going to be massive. And my mentor told me in 1998, when I first started really active day trading, that when you have an announcement, let's say it's Monday, that doesn't impact the markets on the bottom line on Tuesday, Wednesday, and Thursday. It's going to be 6, 9, 12 months down the road before that 25 basis point increase really starts to trickle down to the economy and we feel it. Yes, the prices of stocks will move aggressively the day that announcement's made, but the real adjustment to price of earnings and things like that and economic data aren't going to happen for another 9, 12, maybe even 18 months.
No, I absolutely agree. And the problem with this also is, and the Fed lets themselves off the hooks, and I think they have to, because they're saying any projections they're making are data determinant.
Right.
And let's be honest, and I'm not trying to let them off the hook, but we are literally in uncharted territory here. This is economic intervention, intercession, the likes of which we have never seen. I'm not trying to be overly dramatic, but it's true. So we don't have a playbook here. And we're literally, as you know, we live month to month with a crapshoot of what is the CPI number going to be this month. And then we base policy on that.
Right.
So I worry that, the Fed, the Fed themselves scares me, because they themselves put out last meeting that they expect inflation this year to be 4.2%. What are they, hallucinating?
Yeah, that's some really good acid.
Inflation is already running at 7.9. That means if you're going to get it down to 4.2 by the end of this year, you got to have some pretty dramatic cuts in inflation the Fed is expecting. Yeah. So are you telling me they're basing current policy on the expectation that inflation is going to be cut dramatically in the next couple of months magically to get us down to 4.2%? I don't think they fully grasp what, the reality of what's going on.
And I think that's why this chart is so good. This one of the futures is this is not the Fed. This is not the Fed making these gambles and these rates. This is traders. This is Goldman Sachs, Merrill Lynch, J.P. Morgan. It's their traders, their analysts saying, this is what we see. And I'll be brutally honest. I know you work for the Fed sometimes. I'm going to trust what the traders are seeing here more over what the Fed's telling me, because I feel that the Fed wants us to feel warm and fuzzy. All is calm. Don't worry. But in my opinion, the building's on fire. Don't remain calm. Run. Get out of the building. It's that kind of attitude for me. But I thought that this was a very interesting shift, because it's added another basically another full percentage point in the Fed funds rate since we talked with Bill last time, which was about a month ago. Went from 1.5 to 1.75, and now they're expecting it 2.75 to 3%. That's significant increase.
And that it shows. And this is my real fear here. It sounds like a therapy session. I'm talking about all my fears here today. But the rate at which inflation can spike, and we have seen this dramatically in the past, is frightening.
Yeah.
That when inflation rears its ugly head, it usually doesn't creep into the room. It hits you with a bang. And, I showed you a chart here where if you go back, we had in 1976, the rate of inflation here in the U.S. was 4.86%. And at that point, the Fed funds rate was around 5%. Well, by 1979, inflation here in the U.S. was over 13.25% in 3 years. We went from under 5% to over 13% in 3 years.
Yeah.
Well, guess what, folks? Inflation's already at 7.6.
Yeah, I'm drawing along with you as you were mentioning that, and I'm going to go back just a hair here, just for everybody, so you can see the visuals we had here on this chart. In 1976, I think this goes back to your point, Big Eb. He says in the 1970s, when the inflation rate was 10%, the Fed funds rate was at 14 at the same point. How the heck do we ever get from here from 25 basis points currently? Well, this visual, this red line I put on this chart that Bill sent me, that is just outlining 1976. And you had the Fed inflation was around 4.86. Well, the Fed funds rate had dropped pretty significantly too. It was down around that 4 or 5%. It's really when we get to 1979, you had this real run up. I mean, it was just surging with regards to the Fed funds rate. But inflation had already outrun that. Inflation, when this red bar shows the Fed funds rate between 6 and 10%, inflation was already at 13. And here we are. This is where I'm scratching my head. And honestly, like many of you, I don't know how the hell this story is going to end, but I don't think it's going to be pretty. We are already at 7.6, which is way higher than we were in 1970s. It's almost double what we were at in 1976. And the Fed funds rate was already at 4.8. Well, we're 50 basis points. Yeah. 25, actually. Sorry. So, how do you think, does Bill think that we will? Does Bill think that we will ever get, to that 14% rate?
It's what keeps me up at night. I guess I do fear it.
You have a lot of things that keep you up at night, buddy.
I guess I do. The moral of the story is I don't get much sleep. I do worry that the Fed has really gotten behind and they're going to have to play catch up. And yes, this is my biggest fear, is that we are going to get into that stagflation model, which means the only recourse is you have to drive the economy into a recession. So I don't think there's a soft landing opportunity here. I really don't. The question is, how hard is the landing going to be?
Yeah.
And I want to throw one other number out there, just in putting together some notes for you. And this is a little bit before my time as a consumer, but I was around. In 1971, Richard Nixon put in price controls. Remember, that was an economic experiment that was horrible. We all studied that they tried to artificially freeze everyone's wages and prices here in the U.S. And they put in price controls because inflation was out of control. We had to curtail it by putting in these artificial limits. Well, out of control inflation in 1971 was 6.8%. Inflation spiked up to 6.8%. The government panicked and they put in price controls. Right. And here we are, we're at 7.9, and we're kind of yawning about it.
Yeah, I know. That just seems remarkable to me that we can have a chart that looks like this and not think, you know what, there's something wrong here if we keep these rates as low as they are.
Yeah. So the big question is what's going to happen at the long end? And in answer to your question, the question that came in, I personally think inflation, the yield curve is going to continue to steepen. That's the reality. I don't think the next cycle is going to be for the inversion. I think it's coming eventually, but I think we've still got inflationary pressures. So my personal expectation is that long rates are going to continue the upward path. I mean, look at today. I mean, look at the yield. What happened today in the 10-year went up by 15 basis points today. We had more volatility in the 10-year Treasury than they had in the Dow today. So
I'm bringing that chart up, everybody.
Yeah, I mean, we went from a 1040 to from a 240 to a 255 today is the yield on the 10-year.
Right.
15 basis points in one day.
That's huge.
Yeah.
And you look at the trend that I've got here on this U.S. The 10-year, guys, I've been talking about this one for quite a while. Those of you who are regulars on the show, that this thing, the trend is your friend here. And if you look at the trend in that 10-year, higher lows and higher highs, we just broke out, and now we're challenging some supply levels, kind of at 260. After that, I think you're hitting 3%, and that could happen very quickly here going forward.
Yeah, that's. I think those are the pressures that we're dealing with. Absolutely.
Can I get Bill Addis' Twitter ID for you? Bill, I don't think Bill has a Twitter feed. He should.
Yeah, Bill, good. I'm hearing that more and more. I do not. I'm old school.
He uses LinkedIn.
I do use LinkedIn aggressively. I put a lot of articles up on LinkedIn that are very much the same things you and I are talking about all the time. So LinkedIn is my only social media.
If you search for William Addis on LinkedIn, let me see if I can bring it up here for everybody just so I may as well get you a nice little plug, right?
Well, thank you.
Yeah, gotta get you those followers. Let's see, where did he go?
That's me with a Muppet character. That's me standing next to a Skeksis.
That's right, a Skeksis. And for those who don't know, while I'm doing this, tell them the story on why you're next to. Some of you guys might remember the movie Dark Crystal. So why would you be standing next to one of those, Bill?
Yeah, well, it just so happens that Dark Crystal was one of my favorite movies from Jim Henson. Some of you might remember back when he did Labyrinth and some of those movies. And it was recreated by Netflix 3 years ago as a 10-episode series. And I'm very proud that my son was both the creator, writer, and producer of that Netflix series. He wrote those scripts and produced that series, and he spent 3 years in London doing that for Henson Studios, and then proceeded to win the Emmy for Best Children's Movie that year for that Netflix series. So that's me on set of the movie being produced. So I'm very proud of it.
Wait, so you're telling me that Dark Crystal's a children's movie? That was a dark, evil...
Yeah, it was, exactly.
That was a scary, creepy movie, man.
I was going to go by that quicker. They don't have a Muppet category or a puppet category, so they decided, all right, we'll make it a children's movie. And yes, it's very dark. I would not recommend young children to see that.
You know, there's one that kind of rings true. I don't know if anyone else has seen this movie. There was a Peter Jackson who did Lord of the Rings and all these amazing movies, but when he started out, he was like a 14-year-old kid making movies in New Zealand. He ended up doing a movie called Meet the Feebles. If you guys have a strong stomach and you are an adult, do not play this for children. Meet the Feebles is like the Muppets, but like a hard R-rated Muppets movie. I mean, they're all doing drugs and people are getting... It's just crazy in this movie. Anyway, I don't know why I went on that tangent, but...
Well, thank you for that plug for Dark Crystal. But yeah, that's why I've got a Skeksis next to me.
Nice. So you guys can contact Bill that way. What was the... I'm scrolling through to see if I can find some of these other questions that came through because there was a bunch of them. Let's see. Zanzibar says, does Bill care about or trade the 5-year U.S. Treasury? No. Does the 5-year mean anything?
Good question. No, and I don't, because now, having said that, if you look at the yield curve as we talked about, there was a lot of yield differential year over year to the 5-year. So from a yield point of view, you saw a lot of upward yield movement, downward price. The problem with it is it's a short maturity, meaning it has a low duration, low volatility. If you're going to be trading, you want vol. And I got to get nerdy for the group in a moment. The measurement of volatility for a bond is a concept called duration. And duration will tell you, given a certain change in interest rates, how much the bond will change. And the single largest factor that affects that is the maturity. So the good news is you got a good amount of yield changes in the 2-year, the 3-year, and the 5-year. The bad news is it doesn't really amount to much in terms of price differential compared to the longer maturity. So for active traders, they don't really like that because you don't have as much volatility as they would like. And the other problem is this change that we've seen over the last year with the marketplace pricing in this upward movement to Fed funds is rather aberrational. I mean, it really is odd for short-term interest rates to move as much as they have over the last year. Not many people would have predicted it, quite frankly. Even as we said, right? Even in December of last year, we were only looking for 2 Fed funds hikes, 2 hikes to short rates. Now we're talking about 8 of them. So yeah, maybe if I could go back in time and knowing what I know now, I should be trading the 5-year. But who would have expected this much yield differential? But unfortunately, even with that much yield differential, it doesn't equate to as much price change.
Yep. Guys, some of you have asked about an animated yield curve. I actually use this tool a lot. I'll put it in the chat as well if you want to keep it in your arsenal, everybody. It's just it shows you an animated yield curve, and it's really cool. You can move it along with price and see what the market looked like with each different type of yield curve. And you notice that right now on the hard right edge, we have steepened significantly. So let me ask this question from Ava. I hope you're still here, Ava. That was a great question that you sent in earlier. It says, what does he think is more likely to happen? Are we looking at inversion or steepening of the yield curve?
Yeah.
I think I know the answer.
Yeah, I'm looking for the steepening.
Yeah.
I just see, with the acknowledgement the Fed's bringing up short rates, I just think the pressures of continued inflation problems that brought long-term rates up to where they are now are just going to continue. So yeah, I do not think we are yet pricing in the recession. I think it's ultimately going to have to come, and I think it's going to be a hard landing. But I think we've got more pain in front of us first in terms of inflation. I remember the 1979s. I guess it scarred me. I remember 18% mortgages and 14% treasury bonds.
Right.
Maybe it scarred me.
Well, it should. It should leave a mark, and hopefully it's not one that leaves you without limbs, But you got to have a memory of it, just so that you learn from that in the past. And unfortunately, I don't remember anything those big 1980s high interest rate markets. I was a child at that point, so it didn't really make much difference to me. But now as an adult, you start to look back at history and say, well, what can I learn from that past? And I agree. I think Tom said, I doubt we'll get to those levels that we saw, so in the 80s. But you never know. I mean, there's a great question that came through here, which from Christy says, how high will the 10-year yield go if the Fed backpedals? So what are your thoughts? I mean, is there a level you go, there's no way we're going this high? Or what are your thoughts on height of the 10-year yield?
No, and I'm going to give myself that caveat, just like the Fed did, saying everything is data determinant. Mm-hmm. So I would say, and it's almost directly in sync with what you said, I think it's very easy to put together a scenario which on this movement, if we will, to get the 10-year to 3%. I think that's easily achievable as this cycle. Then the question is, what has the Fed been doing? As I said, we're in the middle of this untested economic experiment. I would love to hope that the Fed could orchestrate this soft landing and do that juggling act between inflation and the economy. But I think we got to give ourselves some time to see how this is going to play out. So I think I'm going to give myself a caveat saying I think the next move on the 10-year is up to 3%. But then I'd like to then take a look and see how things have developed up to that point. I also do want to point out for the group, though, we're talking about the 10 years now hitting some yields it hasn't hit in a long time. Well, that also means your mortgage rates are going higher.
Right.
I want to point out to someone the mortgage market, 30-year mortgages correlate to the 10-year treasury. So as we're seeing the 10-year trade up now to 255, mortgage rates are also hitting highs they haven't seen in a while. We're up now over 5% on the national average.
Yep. I will piggyback on that one and just say, this obviously we're not giving financial advice because I'm not a financial advisor. But here's one that I will say. If you have an adjustable rate mortgage at this point in time and you have not refinanced to a fixed rate, you should just leave your house, stop watching the show immediately, go down to a lender, and get out of your adjustable rate mortgage, because the probability of rates going up, I would say, is about a 99.9% chance. And if we have 12 rate increases this year and you're in a variable adjustable rate mortgage, you're going to get screwed. So if you have one, change it immediately. Even if you have to pay a premium, get out.
I echo that 100%, which also let's try to end on a positive note. There are some winners here.
Yep.
And the winners is that savers are finally going to start getting compensated for being fiscally responsible. Up to this point, anybody who was saving money was a fool because they were just losing based on, inflation eating it away. Now with the Fed bringing up short-term interest rates, savers are going, we're starting finally to see some even, oh my God, double-digit returns on a money market fund. Who would have thought?
Yeah. But you're still going to lose to inflation, aren't you?
Oh, you are? No. I'm in no way trying to say that the rate of return, we have a total mispricing in the market. No. But,
okay.
I'd rather earn 2% than earn nothing.
Right.
That's the bottom line reality. So either way, you're still not going to do better than the rate of inflation. But at least we're narrowing that gap. You're being less taxed. Inflation is a tax. So to the extent you can earn income, you're being less taxed.
All right, cool. Let's see. I had more questions. Ava, we talked about the Elon Musk thing on yesterday's show. Went kind of a little bit in depth on that one. Joe asked you a question, Bill. He says, does Bill have an opinion on Ray Dalio's take of cash being trash? Why not go to cash when things are as volatile and uncertain as they are now?
I do respect a lot of Ray's opinions, I have to admit. I get all of his books. I think what Ray is saying is, and I can't disagree with this either, there are certain dead assets, and there are times when cash is just a dead asset. And I would point to, if you want an illustration of that, go to Germany right now, where if you hold money in cash at a bank, they actually charge you to hold your money. Talk about cash being trash. So in today's economy, because of what central banks have done and the yield curve, the interest rate manipulation they've done, number one, and the amount of monetary policy they've done of just printing up money, I think there is a strong argument that says cash is trash.
Yeah. All right. Well, to that point, we talk about cash as trash. I would say experiment with different asset classes. So, for example, I get to do my gratuitous plug. I will be in Las Vegas, and unfortunately, my graphics a little cut off here, but I'm going to be at the Money Show. If anybody wants to come to Las Vegas, you can come to the Money Show. I'll be presenting on May 11th, doing a live presentation, a meet and greet or something. I don't know. They set up a meet and greet. I don't really care for those, but hey, we'll do what we have to do. It's called 3 Easy Ways to Supercharge Your Portfolio with Digital Assets, and the reason I brought that up is I think it does tie into Joe's question about cash being trash. And if you are going to cash, this is something that a lot of you who are in the crypto space understand, is if you are in US dollars, you're losing to inflation right now. However, if the dollar does increase greater than the rate of inflation, then you will have done well. I would argue that you should put your money into a stable coin that has some auditing to make sure there's actually cash there, and then you could actually earn a yield on that. And some of these stable coins are paying 19% interest on your stable coin. So now you could be in a stable asset. If you want to go to cash, you can go to cash, just keep it digital, and earn a far greater rate of return than you'd ever get in any savings account in any part of the world using that. So I think that would be a good way to place your capital. And if you're uncertain about where things are going, go to cash. These markets will probably continue up for a while until the brakes are applied hard enough, or the wheel actually stops spinning from these brakes being applied going forward. Bill, tell me about your classes. You've got this Bond Aid course with Online Trading Academy, so maybe get a chance to talk about that one.
Yeah, we've got a couple of things going on, but before I can't pass on without pass the opportunity to say congratulations. You're taking the crypto show on the road. May 11th in Las Vegas. Congratulations.
Thanks. It's fun. Yeah, I used to do a lot of presentations for the Money Show and the Traders Expo. I'm a fan of the Money Show and the Traders Expos. I just think it's an experience. And when you go there, again, be careful, because there are some people out there that are slimy, and you just got to be able to read through their lies and see what they're talking about. But there's also some really good education and some good talking points. So I was happy to be invited back.
Congratulations. That's wonderful. Wonderful. And I echo your statement on stablecoin. Anyway, yeah, a lot of things going on coming up, just to make people aware. We've now gotten into a monthly XLT schedule. So my XLT for this month will be 1 week from today. And I'm going to continue to pound the drum a bit on the floating rate bonds, because again, I continue to see inflation as a problem. Inflation has proven to be a problem. And there's bonds that let us take advantage of that. And, the I bonds that you and I have talked about at length, continue to offer 7.11% government guaranteed yield. But I got to remind people, and I wanted to throw this in and catch you for this session, that interest rate changes at the end of this month. Mm-hmm. So you'd only be earning 7.11 through the end of April, when the coupon will be reset. Now, it's my expectation, as I've been running the numbers, that the coupon's actually going to be higher because inflation has continued to grow for the last 6 months. Right. But if you're at all worried about that, is what I'm suggesting, is maybe you want to wait until the new coupon reset, and because you are locked in for at least a year on that. But the I bonds, a bond that's linked to inflation turns a negative into a positive. Right. So we're going to talk about this whole topic on the XLT next week. And then, as you said, I'm doing a 3-day series with OTA called the Bond Aid series, where we talk about the economy, interest rates, the Fed, the interaction between all of these different markets. And that's going to be held on May 25th through the 27th. But what we do on a weekly basis leading up to that for 6 weeks before is I do a 1.5-hour session every week called the Signature Series. And that will be coming out starting at the end of this month. So we'll have a weekly session going on, bottom line is what I'm saying in a long-winded way, leading up into the Bond Aid class at the end of May.
I have the calendar up here. There is an XLT.
Thank you.
Yeah, have the calendar up. So for those of you who are in Online Trading Academy, you can just go into my OTA and then just type in, under your calendar, you just type in Addiss and you'll see what he's got cooking. There is a general session next Tuesday, the 12th, which you'll be doing for the XLT. Right. And that's April, yep. And then you can see he's got his Bond Aid companion. So what's nice about this is, you go through his course and then you have these sessions where you can kind of touch up on and go over topics as they happen. And obviously, recently you're seeing just a ton of information with regards to bond markets. It's becoming one of the more talked about items on financial television, other bond markets, bond yields, etc.
Yeah, it took 40 years, but we finally got in vogue, us bond guys.
There's always this rotation. There's always an ebb and flow. But you're right. It's been about 40 years since people really knew what bonds were, right?
I had people I'd never heard from for 20 years calling me up saying, "What's an auction and why do I care?"
Indigo says, "What about the TIP ETF?"
I like the tip ETF for liquidity purposes. One of the problems with regular bonds, and this is tips as well as any other, is it's an over-the-counter product. The problem you have with the tips ETF is they're taking the 10-year tips, repackaging it into an ETF format. But the problem you have is the coupons on tips only reset every 6 months. So you can get a period of time where it will actually show that a tip is showing you a negative rate of return because the price is reflecting the fact that coupon is going to be reset shortly. So for liquidity, for pricing purposes, they can actually be somewhat problematic. So the good news on a tip long-term, a tip ETF, is you enjoy the liquidity of the ETF. The bad news is the way tips price, it can make it cumbersome for the retail investor to understand, and in fact can be detrimental. You want to wait until the coupons reset before you liquidate it, if that makes sense.
Yeah, absolutely. So I have
I like ETFs for liquidity.
Yeah, I mean, it's nice because you do have that liquidity aspect to it, but it doesn't function the same way as actually owning a tip. So
exactly,
S-tip is one. That's what I have on the screen here. And then, yeah, Alan G says, if you looked at the monthly trend on the 10-year, yep. And that's the big thing. Here's your monthly. We've looked at this earlier. You have this monthly slight uptrend, but you look long term and going back to the 80s, this has been one of the biggest downtrends you're ever going to find. And, who knows? Maybe this is the reversal, and all of a sudden we now start to get the uptrend. So if you're somebody who practices supply and demand, you know that the trend is your friend until the bend at the end. So at this point, it's about buying pullbacks in this one. So as you see the yield start to fall, buy some. And this futures product will probably continue up. Again, we have to get above that 3.2%. You get above that, and then all of a sudden, I think you've got smooth sailing up to maybe 5-6%, but that's a long ways down the road.
Yeah.
All right, Bill. Hey, thank you so much for coming on today. I appreciate it. Always a pleasure having you on for our monthly soiree. I'm sure we'll talk to you next time, probably next month when we get the FOMC meeting to do a little recap and see what happened there.
Let's talk tapering next month.
Ooh, tapering. I'll bring my pom-poms so we can cheer the market on.
Cheer on.
All right, Bill. Hey, thanks so much. Appreciate it. Have a great session, and I will talk to you soon.
Always a pleasure, guys. Thanks to you and everybody out there. Be well.
Bye.
Bye now.
Yeah, that was Bill Addiss. He teaches from the Trading Academy. He also has got some his own teaching stuff going on. I believe it's Amherst Training. I forget the URL. Actually, I think I can bring it up here. It is. Let me real quickly bring this one up just so I can get the name and email for you. And it is Amherst. I'll just bring it up with a black screen. How about we just do that? Let's go. Here you go. There's Bill's email at the bottom. It's amherstft@gmail.com if you want to get in touch with him. But does a lot of great stuff for Online Trading Academy. I love his Bondage series, and every now and again I'll sneak into his companion sessions or watch the recordings because I just think that there's so much going on behind the scenes with digital assets, digital assets, with bonds, interest rates, and what the Fed is doing at every step of the way. And I love having Bill's input. Anyway, hope you guys enjoyed that session there with Mr. Bill Addiss. All right, that's gonna do it for me. I didn't realize we were going this late. I had some other stuff I wanted to get into, some listener questions, but I am out of time because I got stuff I got to prepare for tonight. So let's just say if you guys have any comments, questions, feedback, things you want to talk about, put them down below the YouTube video. That's the best way to help out this channel other than sharing this and spreading the word. If you have something you want me to discuss, you can also email me at TraderMerlin@gmail.com. There really isn't a lot of stuff to pay attention to for tomorrow's session with regards to earnings. However, on the economic calendar side, there is some stuff happening for Wednesday's session. First and foremost, you have those FOMC meeting minutes. Why is that important? Well, because as Bill has mentioned, they've been very transparent so far with what they are doing, how they're going to do the rate increases. And right now, as I saw in the last week or so, the change has significantly shifted with regards to rate increases, meaning much more aggressive forecast for the remainder of this year with regards to rate increases. And I'm curious to see if the Fed meeting minutes may allude to some of that on pressures to maybe raise rates a little bit faster because of Russia, because of oil, because of commodities, whatever that one is. With those factors, I think you might see a pop there. Now, that announcement comes out at 7:30 Pacific time. So 1 hour into the trading session, you will see that announcement come out. Other than that, not too much big stuff. You have crude oil inventory. So Joe says, careful with oil. Oh yeah, be very careful with oil. They're expecting to have a big contraction in supply. Let's bring up. We didn't even look at the markets today. Maybe I should look at the markets. Jeez. Here's your crude oil, which was not doing so well today. Let me get this my drawing off of here. Talk about a wonderful shooting star, and there's your daily of it. Just kind of compression with crude oil, but given what's going on with Russia, they're talking about new sanctions for Russia. Also, the inventory numbers coming out tomorrow. Be very careful because that could create some big whipsaw action in crude oil. So I agree with you on that one, Joe. As far as market moves today, boy, NASDAQ was great. Talk about, some might call this a tweezer top, where you just shoot up and come ripping right back down. Gave back all of yesterday's amazing gains all in one session. Gotta love that for the NASDAQ, down 2.2%. S&P was down 1.26%, erasing all of yesterday's gains. Same thing with the Russell. Russell came right back down to this green line. Remember, we'd drawn this line at 2045, which is kind of the bounce point here going back to March 23rd and 24th. We screamed down to that today. If we get a close below it, I think you might see us challenge these lows back here at 1935. So we'll have to wait and see how it all pans out, because there's obviously a lot of volatility out there. As far as commodities go, I did not sell the 2350 puts or calls on my silver. Still holding it. I'm waiting for a little bit more of a run up before I start selling those calls on it so I get more premium. And then what else do we have? Gold down 0.34%, but again, nothing really interesting on gold. Silver looked a little bit worse. I started off strong and then all of a sudden dropped fairly quickly. We're down about 1.19% on silver. And then crypto, well, not much to say here. You've got almost what looks like a pennant formation or a bullish flag on Bitcoin, which right now is 0.1%. So there you go. There's your markets in a nutshell. Okay, cool. I guess that's going to do it for me, everybody. I'm going to go out and try to enjoy some sunshine and have a great remainder of the day. I hope you all enjoyed Bill Addiss. If you want to find out more, go to tradingacademy.com. You can find out about his courses there. One's called Bond Aid. He also does a bunch of general sessions. And I will see everybody on tomorrow's show. Oh, going forward, I am going to have John Rowland on Thursday. Sam Evans should be on next week as well. And I'm going to try to sprinkle on a couple of the suggestions that you guys have given me. I just have to be proactive and go and contact these people and grovel and be like, want to come on my show? I'm also trying to get a woman to come on and talk about NFTs. As an individual I've been following for a while who I think does some really great work with regards to non-fungible tokens and that whole ecosystem, and that might be of interest to you as well. All right, everybody, that's going to do it for me. Hope you enjoyed today's show. If you did, let me know underneath that YouTube video. Until then, happy trading. I'll see you tomorrow.